Imagine owning a multi-billion-dollar stake in precious metals, like gold and silver, getting all the upside from soaring prices, but without ever digging a single hole or managing a mine.
Sounds almost too good to be true, doesn't it?
Exactly. Well, today we're diving deep into Wheaton Precious Metals. That's a company that built an entire empire doing just that.
Right.
We'll unpack whether their unique streaming model is really the smartest way to play the gold and silver market, especially now. I mean, gold's around $3,400 an ounce, silver's at $38.50. This is as of August 8, 2025.
Yeah, big numbers.
By the end of this deep dive, you'll really get the fascinating trade-offs and maybe some of the crucial questions behind their success.
That's the plan. Our mission today is to cut through the noise, extract the most important nuggets of knowledge from our sources on Wheaton Precious Metals, or WPM as they're known.
WPM, got it.
Think of this as your shortcut to being genuinely well-informed and quickly. We'll cover, well, everything from its innovative business model, their financials, which are pretty robust, the leadership team.
And the risks, too, right?
Oh, definitely. And critically, the surprising risks and opportunities that you, our listener, really need to grasp.
Okay, so to make sure we cover all that ground, we've structured this deep dive into two main parts.
Makes sense.
In part one, we'll kick things off with Chapter 1, Business Understanding. Then we'll move straight into Chapter 2, Management Evaluation, and we'll wrap up Part 1 with Chapter 3, Financial Analysis.
Okay, business, management, financials. Got it.
After that, we'll jump into Part 2. We'll explore Chapter 4, Market Sentiment, then Chapter 5, Ownership Structure, followed by Chapter 6, Risk Assessment. And finally, we'll bring it all home with Chapter 7, Conclusion.
Sounds like a solid roadmap. And hey, before we properly jump in, if you find this deep dive valuable, maybe do us a favor.
Please do.
Like and subscribe to the 1 Tree Ounce YouTube channel. We cover all sorts of mining companies, and we absolutely take requests for stocks in the precious metals space. So let us know.
Yeah, definitely let us know. All right, let's get right to it then. What is Wheaton Precious Metals? And how on earth do they manage to profit from gold and silver without ever getting dirt under their fingernails? Welcome to Chapter 1, Business Understanding.
Okay, so the first thing, and it's crucial to understand this, is that WPM is fundamentally not a traditional mining company.
Right, not digging holes.
No, they don't own mines, they don't operate them, and importantly, they are completely insulated from all those typical mining headaches, labor disputes, equipment breakdowns, worrying about fuel costs.
All that operational stuff.
Exactly. Instead, Wheaton operates what's called a precious metals streaming model.
So it's almost more like a specialized bank for miners, focused purely on precious metals.
That's a great way to think about it.
Okay.
Precisely. Here's the genius behind it. Wheaton provides a large upfront capital payment to a mining company.
Okay.
Usually this is for a company that's, say, developing a new mine or maybe expanding an existing one.
Right, they need cash.
They need cash. And in return, Wheaton receives a contractual right to purchase a fixed percentage of that mine's future precious metal production.
At a fixed percentage.
Yes. And crucially, at a deeply discounted, predetermined price. This often covers byproducts like the gold or silver that comes out of a copper or zinc mine, and the agreement lasts for the entire life of the mine.
Okay, life of the mine. That's huge.
Okay.
But what kind of discount are we talking about here? Because this must be where the incredible margins come from.
Oh, it's astounding, really. In 2024, get this, Wheaton's average cash cost was just $440 per ounce of gold.
$440 when gold is at $3,400.
Exactly. And for silver, it was a mere $4.98 per ounce. So when you consider current prices, this model just locks in these incredibly predictable, truly massive margins.
Right.
Think about it, a company in the raw materials sector with an 83.8% gross margin. Nearly 9 out of every $10 of revenue becomes pure profit before you even get to operating costs.
That's almost unheard of.
It really is.
Yeah.
And it speaks to the genius of the model. Plus, like we said, it fully insulates them from those inflationary pressures, rising fuel, labor, equipment costs that traditional miners are constantly battling.
Okay, that brings us to their portfolio.
Mm-hmm.
If they're not digging the ore themselves, what kind of assets are they actually, owning these agreements on?
Huh?
Let's talk about their diversified portfolio and asset quality.
Yeah, so Wheaton's success isn't just the model. It's built on a high-quality, globally diversified portfolio of these streaming agreements.
Okay.
Right now, they have rights covering 18 operating mines and another 25 development projects.
Wow, that's a lot.
It is, and it's spread across 33 different mining partners. This broad diversification across assets, operators, and countries is a really key part of their risk mitigation strategy.
I seem to remember they were originally called Silver Wheaton.
Yeah.
Have they branched out much from silver, or is that still the main focus?
Oh, yeah, they've made a very strategic pivot away from those single commodity origins. It was a conscious move. So in the second quarter of 2025, for instance, their revenue was actually 65% from gold, 33% from silver, and the last 2% from things like palladium and cobalt.
So definitely more gold focus now.
Much more balanced, yeah. It shows they've successfully evolved into a genuine precious metals powerhouse. And geographically, their assets are mostly in politically stable, mining-friendly places, think the Americas, Europe. Key operations include the Salobo mine in Brazil and Peñasquito in Mexico. Big, quality assets.
What's really interesting to me is the longevity you mentioned. These aren't just short-term deals, are they?
Not at all. That's a cornerstone of their portfolio. It's exceptional longevity. The average mine life across their assets is about 28 years, just based on proven and probable reserves.
28 years.
Yeah. Plus, something like 93% of their production comes from mines operating in the lowest half of the industry cost curve.
So efficient mines.
Very efficient, which makes them highly resilient even if commodity prices dip. And remember, those streaming agreements typically cover the entire life of the mine. So if the miners find more gold or extend the mine life,
Wheaton benefits.
Wheaton benefits at no extra cost to them. It's basically free upside potential baked into the deal.
Okay, so if they're not a miner, what's their specific niche then? Let's look at their market position and industry environment. Where do they fit in the bigger picture?
Well, Wheaton stands as one of the absolute largest and most dominant players in this specific royalty and streaming space.
Right, the streamers.
Yeah, alongside Franco-Nevada and Royal Gold, those are the big three. Wheaton's market cap is soaring, over $45 billion now. That puts them way up there, even among global materials companies.
Wow.
And their value proposition is really clear. They offer investors a smarter, arguably lower-risk way to invest in precious metals. You get the upside of rising prices without the direct operational headaches and costs.
And they're certainly operating in a pretty hot market right now, aren't they? $3,400 gold doesn't hurt.
It definitely helps. As of August 2025, precious metals are in a clear bull market, no question.
What's driving that, do you think?
It's a mix. Yeah. Geopolitical instability, for sure, persistent inflation concerns, and just strong investment demand. You saw North American-listed gold ETFs alone pull in an incredible $21 billion in the first half of 2025.
$21 billion. Just in ETFs.
Yeah, just in the first half. That's a massive amount of capital looking for precious metal exposure. And companies like Wheaton are, direct beneficiaries of that flow.
So with such a compelling model, what's the competition like? Are loads of new companies trying to become these sort of mine financiers, or is it a fairly exclusive club?
It's largely an oligopoly, dominated by those three majors we mentioned: Wheaton, Franco-Nevada, Royal Gold.
Okay, the big three.
The competition between them is fierce, definitely, but it's mostly for securing new streaming deals, not really for selling the metal itself. And the barriers to entry, they're formidable.
How so?
Well, you need massive amounts of capital. We're talking hundreds of millions, sometimes billions, for a single deal. You need deep technical expertise to even evaluate these mining projects properly. And you need a sterling reputation, strong relationships with the miner.
Right. Trust is key.
Absolutely. It makes it very, very difficult for newcomers to just break into the space and compete effectively.
So when we think about, say, Warren Buffett's idea of a moat, that durable competitive advantage protecting profits,
Yeah.
how does Wheaton stack up? What's their competitive advantage?
The moat.
Wheaton's moat is, I'd say, incredibly wide and deep. It's built primarily on its structural cost advantage.
The low purchase price.
Exactly. That fixed, low-cost nature of the streaming model means that as commodity prices rise, Wheaton's cash operating margins just automatically expand. Like I said, in 2024, their cash operating margin was an astounding $1,977 per gold equivalent ounce.
Gold equivalent ounce, so that blends all the metals. Yeah, it's a way to combine the value of the gold, silver, palladium, etc. into one comparable unit based on current prices, and that $1,977 margin. That's a level of profitability and predictability that traditional miners simply can't hope to match.
And it sounds like their existing portfolio of deals is almost a moat in itself, just impossible to copy quickly.
It absolutely is. Their portfolio includes interests in some of the world's largest, lowest-cost mines run by top-tier operators. To replicate a portfolio of that quality, that diversification, that longevity, it would take a competitor decades and, frankly, tens of billions of dollars, if it's even possible.
Right.
This basically ensures a steady, reliable stream of precious metals for potentially decades to come. It gives them a huge lead time and a significant strategic advantage.
Okay, we've got a really clear picture of the business model now. But who are the people, pulling the strings behind the scenes? Let's talk about the leadership. Welcome, Chapter 2, Management Evaluation.
Right, management. Wheaton's team is really characterized by deep industry experience, impressive long tenure, and, frankly, a track record of exceptional performance.
Who's at the top?
Randy V.J. Smallwood. He's actually a co-founder of the original Silver Wheaton, and he's been president and CEO since 2011. That provides crucial strategic continuity.
Long time.
Very long time. And importantly, his compensation is mostly performance-based, which directly aligns his interests with yours as a shareholder.
And it sounds like they've been pretty thoughtful about succession, too, promoting from within. What kind of impact has this leadership had over the years?
They certainly seem to have planned well. Just recently, in June 2025, they promoted 2 long-serving executives from inside the company. Haytham Hodaly became president. He's been key in over $10 billion worth of streaming deals since 2012.
Wow, $10 billion.
Yeah. And Kurt Bernardi was promoted to EVP, Strategy, and General Counsel. He's been structuring many of their cornerstone deals since way back in 2008.
So real experience there.
Deep experience. Promoting from within signals a strong internal talent pool and maintains the company's successful strategy and culture, and their track record. Genuinely impressive. Get this. Since inception, Wheaton has recouped over 100% of the total value of its initial upfront investments across its entire portfolio.
Recouped everything they put in already.
On average, across the portfolio, yes. It shows they are incredibly skilled at picking winners, selecting profitable, high-quality streams.
Okay, so with all that cash flowing in from these deals, how does WPM decide where to put its money next? What's their capital allocation strategy?
Management uses a pretty clear, disciplined, 2-pronged strategy. It's focused on growth, but also shareholder returns.
We get growth first.
Yeah. The primary use of capital is aggressive but disciplined. Reinvestment into new, accretive precious metal streams, meaning deals that add value.
How aggressive are we talking?
Well, in 2023, they committed over $1 billion to new deals. In 2024, over $900 million. This M&A activity is really the engine driving their future growth.
And crucially, is that growth self-funded? Are they taking on a load of debt to do these deals?
No, and that's key. It's funded entirely by the company's robust internal cash flow.
Wow.
This allows them to grow without taking on risky debt or diluting existing shareholders by issuing lots of new stock. A powerful self-funding growth cycle.
Can you explain that cycle a bit more?
Sure. Higher metal prices lead to higher cash flow from existing streams. That higher cash flow provides more capital for them to deploy into new deals. Those new deals then lead to even higher future production and ultimately higher future cash flow.
Ah, a virtuous cycle. Got it.
Exactly, a virtuous cycle.
What about returning value directly to shareholders? Are they buying back stock, or is it mainly about the dividend?
Their main focus for shareholder returns is definitely the dividend. They have what they call a progressive dividend policy.
Aggressive meaning?
Meaning they aim to increase it over time as earnings and cash flow grow. To date, they've declared something like $2.4 billion in dividends.
That's substantial.
It is. Their most recent quarterly dividend was just raised by 6.5% to 2.1656 per share. That reflects strong confidence in their long-term cash generation. And importantly, they have a conservative payout ratio of around 36.9%.
Meaning they only pay out about a third of their earnings.
Roughly, yes. Which means there's plenty of cash left over for those growth investments and ample room for future dividend increases and flexibility. They notably don't really engage in significant share buyback programs. They prefer putting capital into new streams and direct dividend payments.
And how effective is this overall capital allocation strategy when you look at something like return on invested capital, ROIC? Are they getting good returns on these investments?
Yeah, their normalized ROIC is reported to be impressively high, somewhere between about 7.8% and nearly 12%.
That's quite a range.
It depends on the year and calculation, but consistently strong. It tells you they're incredibly efficient at turning their investments into profits, matching or even beating the best in their peer group, like Franco-Nevada and Royal Gold. It's not just growth for growth's sake, it's clearly profitable growth.
This business model just sounds incredibly strong, insulating them from so many typical mining risks. But there's always a catch, isn't there? Often, it's the price you have to pay. Let's dig into Wheaton's financials. Welcome to Chapter 3, Financial Analysis.
Okay, yeah. A look at Wheaton's financial statements really does reveal a company with exceptional profitability and a rock-solid financial foundation. It clearly reflects the strengths of that streaming model we've been talking about.
Let's start with their key financial metrics. How's revenue been looking recently, and what about those, well, legendary margins we heard about? Do they hold up on paper?
They absolutely do. After a bit of a dip in 22 and 23, revenue growth has really reaccelerated quite significantly. That's driven by both higher commodity prices and contributions kicking in from new streams.
Okay,
Their trailing 12-month revenue, TTM, as of March 31st, 2025, was a very robust $1.46 billion.
solid number.
Very solid. And their profitability, truly world-class. Margins are in the high double digits right across the board. We're talking 83.8% gross margin.
84%.
Yeah. 55.7% operating margin and 47.5% net profit margin for the TTM period. These figures are just a direct result of that low fixed cost streaming model.
What about free cash flow? FCF? They can sometimes be a bit volatile for companies making big investments, right?
That's true, and FCF has been variable over the past 5 years for Wheaton, but, and this is important, this isn't really a sign of instability, it's more a feature of their business model.
How so?
Well, their operating cash flow, the cash generated from the core business, is consistently strong. It was over $1 billion in 2024 alone.
Okay, so they generate plenty of cash.
Plenty. The fluctuations you see in free cash flow are mainly driven by those large discretionary upfront payments they make for new streaming deals. Those are essentially significant investments in future growth, not a sign of shaky operations. They generate lots of cash, it's just sometimes immediately redeployed into buying future streams.
Okay, that makes sense. Let's talk balance sheet. You called it rock solid. Is it truly a fortress balance sheet? That's quite a claim.
I stand by it. Wheaton's balance sheet is arguably one of the strongest in the entire materials sector, not just among streamers. They are, for all practical purposes, debt-free.
Really? Zero debt.
Their debt-to-equity ratio is virtually zero. They've managed to fuel all that aggressive growth we talked about without burdening the company with significant leverage. It's quite remarkable.
And in terms of liquidity, can they easily cover their short-term obligations, handle unexpected issues?
Unquestionably. As of their latest report, they were sitting on over $1 billion in cash. Plus, they have a $2 billion undrawn revolving credit facility, basically a big credit line they haven't even touched.
That's firepower.
Lots of firepower. And their current ratio, which measures their ability to cover short-term debts with liquid assets, is an extremely healthy 7.38, way above what's needed.
And the dividend seems secure then.
Very secure. Given its 15-year history, that conservative 36.9% payout ratio, and the strong cash flows, there's ample room for it to continue and likely grow, even if cash flows fluctuate a bit year to year.
Okay, now for what feels like the central challenge, and maybe the biggest hurdle for new investors looking at WPM today. Let's talk about their valuation analysis. How is the market pricing this company compared to its peers, or maybe its own history?
Right, this is key. The market is definitely well aware of Wheaton's strengths, and it has priced the stock accordingly, maybe even richly.
Meaning it's expensive.
When you compare it to its peers and its own historical levels, yes, WPM trades at a significant premium. Their trailing 12-month price-to-earnings ratio, the PE, is sitting around 57x.
57 times earnings. Wow. How does that compare?
Well, compare that to Royal Gold, which is trading around 26x earnings, or even Franco-Nevada, which is also premium price but closer to 52x.
So investors are paying more than double per dollar of earnings for Wheaton compared to Royal Gold.
Essentially, yes. It suggests incredible investor confidence, maybe even euphoria, baked into Wheaton's price. Their price-to-cash flow multiple is also quite high at 33.7x.
Okay, so relative valuation says expensive. What about intrinsic value? Are analysts using models like discounted cash flow, suggesting it's already priced for perfection, or maybe even overvalued?
Yeah, intrinsic valuation methods generally do suggest the stock is fully priced, perhaps even overvalued, at its current levels around $100 a share.
Any specific estimates?
Well, for example, one model from Simply Walsant calculates a fair value around $67.24 per share. That would imply the stock is currently overvalued by about 46%.
46% overvalued.
According to that model, yes. And Morningstar's analysis points in a similar direction, suggesting the stock is trading at roughly a 42% premium to their fair value estimate, which is around $89 per share.
Okay, so for you, the listener, what does this premium price tag really mean? To justify buying at the current $100.69 share price, you really need to believe a few things quite strongly, don't you?
Precisely. It requires a very bullish outlook on future precious metals. Prices, you need gold and silver to stay high or go higher. And you need high confidence in the company's ability to actually hit that ambitious 40% production growth target they've set over the next 5 years.
So you're not just buying a great business.
You're not just buying the model, you're betting heavily on its continued flawless execution and a sustained strong commodity market to make the current valuation work out.
All right, let's move into part 2 of our deep dive now, starting with chapter 4, market sentiment. What's the general feeling, the vibe around Wheaton in the market right now? Are investors as excited as these valuation numbers suggest?
Oh yeah, the current market sentiment surrounding Wheaton Precious Metals is overwhelmingly positive. You really feel it.
What's fueling that?
It's fueled by that strong financial performance we just discussed, the ongoing bullish commodity cycle, and just incredibly favorable analyst coverage. The market basically sees them as a clear winner in the precious metal space right now.
How are the Wall Street analysts rating the stock? Is it pretty much unanimous on the buy side?
It's about as close to unanimous as you get. The consensus rating is officially a strong buy.
Strong buy.
Yeah. Out of 14 analysts covering the stock, a staggering 12 rate it a strong buy. One calls it a moderate buy, and only one analyst has a hold rating. Importantly, there are 0 sell ratings.
0 sells. That's a statement. What about price targets?
Also bullish, their average 12-month price target is sitting around $108.88, and the high-end target from one analyst reaches all the way up to $141.78. That's a really powerful vote of confidence from the professional analyst community.
And I suppose the news headlines have been pretty positive too, reflecting that optimism. Lots of talk about record performance.
Absolutely. Recent news flow has been exceptionally positive. It's been dominated by headlines announcing record Q2 2025 revenue and earnings, numbers that actually beat expectations.
Beating expectations is always good.
Always helps. And the stock hitting new all-time highs recently has also generated significant positive media coverage, which kind of creates this powerful positive feedback loop. Plus, WPM benefits massively from those broader market trends, like the huge capital inflows into the precious metals sector we mentioned, those $22 billion in gold ETF inflows through July. That helps lift all high-quality boats like Wheaton.
Okay, that brings us to market indicators. Are there any technical signs, things like short interest or moving averages, that back up this overwhelmingly bullish sentiment?
Yes, the technical picture definitely confirms the strong bullish sentiment right now.
Like what?
Well, for one, bearish bets against the stock are minimal. Short interest is very low, only about 1.50% of the public float. That means very few significant players are betting the price will go down. The days to cover is also low, around 3.4 days.
And the price trend itself?
The stock is in a clear, powerful uptrend. It's trading significantly above its key long-term and short-term trend lines, or moving averages. As of August 8th, that $100.69 share price is well above its 50-day moving average, which is somewhere between $91 and $95.
Right.
And it's even further above its 200-day moving average, which is down around $75 to $92. That's a classic technical sign of strong, bullish momentum and sustained investor demand for the shares.
Let's shift gears then and look inside the company. Chapter 5, ownership structure. Who actually owns Wheaton Precious Metals? And what does that ownership picture tell us about overall investor confidence?
Okay, ownership. The structure here is heavily dominated by large, sophisticated institutional investors.
Like big funds.
Exactly. Big mutual funds, pension funds, hedge funds. Institutional ownership is very high. Over 1,000 professional investment firms hold approximately 81.5% of all the outstanding shares.
81.5%.
Right.
That's huge. What does that signify?
Well, such a high level of professional ownership generally suggests a strong degree of confidence from what people often call the smart money. These are typically investors with deep resources for research.
Are there any well-known smart money names among the top holders? Names that might give listeners a sense of the quality of their shareholder base?
Oh, absolutely. The list of top shareholders reads like a who's who of respected, long-term focused investors, particularly those specializing in the resource sector.
For instance,
We've got Capital World Investors, BlackRock, First Eagle Investment Management, Van Eck Associates, who manage some of the biggest gold mining ETFs like GDX.
right, Van Eck.
No,
Yeah.
all of them hold significant positions. Having investors like that on your register represents a really powerful endorsement from people who know the sector inside and out.
What about insiders? Are the executives, the management team we talked about, putting their own money where their mouth is? or is it mostly these big institutions?
Direct ownership by company insiders, executives, and directors is actually relatively low. It's only about 0.12% of the company overall.
Less than 1%.
Yeah. However, CEO Randy Smallwood is the largest single insider holder, and his personal stake is valued at over 55 million Canadian dollars. So it's still a very significant amount for him personally.
Why is the overall percentage so low then?
Well, it might seem small, but it's actually fairly typical for a large company like Wheaton that grew primarily through corporate spin-offs and acquisitions, rather than being, say, founder-led from the start, where the founder might retain a huge stake.
Okay. What about recent trading? Any insider buying or selling?
Recent insider transactions have actually shown more selling than buying, but it's important to put that in context. These sales are often part of pre-planned trading programs known as 10b5-1 plans.
Ah, the scheduled plans.
Exactly. They allow executives to diversify their personal holdings over time in a structured way, regardless of short-term news. So you shouldn't necessarily interpret those sales as a bearish signal about the company's prospects. One final point on ownership. It is fairly concentrated among the top institutional holders. The top 25 shareholders collectively own over 50% of the entire company.
Half the company in 25 hands.
Pretty much. This provides a generally stable shareholder base, which is good, but it also means that a significant change in sentiment, if one or two of these really large funds decided to sell, could potentially have a noticeable impact on the stock price.
Okay, that makes sense. Now, no investment, not even one with a fortress balance sheet like Wheaton, is without risk. So let's really get into that now in Chapter 6, risk assessment. Can you maybe walk us through a comprehensive SWOT analysis for Wheaton? Highlight the strengths, weaknesses, opportunities, and threats, both the obvious ones and maybe some less apparent ones.
Absolutely. Let's break it down with a SWOT. Starting with strengths, and we've covered many of these. That superior, high-margin, low-cost streaming business model is number one. Then there's the fortress balance sheet, virtually zero net debt, high liquidity. You've got the high-quality, diversified portfolio of long-life assets. And finally, the experienced management team with a proven track record. Those are major pluses.
Okay, clear strengths. What about the weaknesses?
The biggest inherent weakness is having no direct operational control over their mining assets. They are completely dependent on the performance of their 33 third-party operators. Another potential weakness is the fact that there's a somewhat limited universe of truly large-scale, high-quality streaming opportunities available globally that could potentially constrain their future growth rate if competition heats up too much.
Right, finding the next big deal.
Okay,
Okay, what about opportunities?
Lots of opportunities. They are perfectly positioned to benefit from a continued bull market in precious metals, which seems driven by ongoing inflation concerns and geopolitical risks. There's also an increasing demand from miners for streaming and royalty financing as an alternative to debt or equity, which plays right into Wheaton's hands.
So more miners might come knocking.
Potentially, yes. Plus, they get that free upside from any exploration success their mining partners have near the existing streams. And of course, there's always the opportunity for further accretive acquisitions to fuel growth.
Makes sense. And finally, the threats. What keeps them up at night?
The most significant threat, always, is a sustained downturn in gold and silver prices. That hits their revenue and valuation directly. Another major threat is a significant operational failure, like a mine collapse or a long strike, or maybe a major political event like nationalization at one of their key partner mines.
That lack of control again.
Exactly. Increased competition for new deals could also drive up the prices they have to pay, squeezing future returns. And lastly, there's always the threat of adverse changes to tax laws or mining regulations in the countries where their partners operate.
That lack of control weakness really seems like the flip side of their biggest strength. You called it the golden handcuffs dilemma earlier. If they are so reliant on partners, how do they actually vet these operations? What do they do to mitigate the risk if a partner messes up?
Yeah, that's the core paradox, the golden handcuffs. Their strength insulation from operational risk is tied directly to their weakness, that lack of control. They are fundamentally a passive financial partner.
So what can they do?
Well, they mitigate this risk significantly through incredibly extensive due diligence before they even sign a deal. They scrutinize the potential partner, the specific mine project, the geology, the engineering, the economics, the management team, everything.
So they choose partners carefully.
Very carefully. They really only partner with experienced, reputable operators and assets that have strong technical and economic fundamentals. And as we mentioned, they diversify across many partners, assets, and countries specifically to avoid being over-reliant on any single mine or operator going sour.
But if, say, Vale has big problems at Salobo and production drops.
Then Wheaton's revenue from that stream is directly impacted, yes. Their main recourse in that situation is contractual enforcing the terms of the streaming agreement. So investing in Wheaton isn't just a bet on gold and silver and the streaming model. It's also an implicit debt on the ongoing operational excellence and financial stability of those 33 mining partners.
Okay. And given that you said there's a limited universe of these really big, attractive streaming deals, how does Wheaton make sure it's always the preferred partner when one comes along? Is it just about having the deepest pockets, or is there more to it, like relationships or technical know-how?
It's definitely not just about having the deepest pockets, although obviously significant capital is a prerequisite. Wheaton's long history in this space, and frankly their sterling reputation within the mining community, are absolutely paramount.
Reputation matters.
Hugely. They're known as being reliable, fair, and relatively non-intrusive partners. They don't try to meddle in the mine operations. Additionally, their deep in-house technical expertise allows them to quickly and accurately assess the viability and the risks of really complex mining projects. Miners appreciate that level of understanding.
So it's a combination.
It's that combination of available capital, deep technical know-how, and being seen as a trusted long-term partner. That gives them a formidable competitive edge when competing for those scarce, high-quality opportunities.
Let's zoom out again. What are the major key external threats they face that are really beyond their direct influence?
Okay, the big external ones. Number one is definitely commodity price risk. We keep coming back to it because it's fundamental. Wheaton's revenue, its cash flow, its valuation, they are all highly sensitive to the market prices of gold and silver. A prolonged bear market in precious metals would severely impact their financial results and almost certainly cause a contraction in that premium valuation multiple they enjoy.
Okay, price risk. What else?
Next is counterparty and political risk. Even with diversification, a significant chunk of their revenue still comes from a few very large key assets, like Salobo in Brazil and Peñasquito in Mexico.
The big ones.
So any major long-term operational disruption at one of those specific mines, whether it's technical, labor-related, whatever, or an adverse political development, like a government suddenly imposing punitive taxes or even threatening resource nationalism, that could materially harm Wheaton's business, even with their diversification.
Unpredictable stuff.
Very unpredictable. And finally, there's valuation risk. As we discussed quite a bit, the stock currently trades at a significant premium. If the company fails to meet those ambitious growth targets they've set, or if broader market sentiment towards precious metals simply sours, the stock is quite vulnerable to a sharp correction as its valuation multiple potentially shrinks back towards historical levels or peer averages. The higher they fly, the harder they can fall.
This has been incredibly insightful, really peeling back the layers on what makes Wheaton tick. Let's try to bring it all together now in Chapter 7. Conclusion. Can you give us a clear synthesis of findings? Maybe lay out the bull case versus the bear case for Wheaton Precious Metals one last time.
Absolutely. Let's synthesize. The bull case for Wheaton is frankly very compelling. You have a superior high-margin business model providing leveraged exposure to precious metals, but largely insulated from the costs and risks miners face.
The best of both worlds, maybe.
In some ways, yes. This model is executed by a highly experienced management team with a truly stellar track record. The result: a company with a fortress balance sheet, a portfolio packed with world-class, long-life assets, and a clear sector-leading growth path aiming for a 40% production increase in 5 years.
So for bulls, it's a safe haven growth play.
Exactly. In a world looking for safe havens, inflation hedges, Wheaton offers a powerful, arguably lower-risk way to get exposure to gold and silver upside. That's the bull story. However, the bear case really centers on two things: that high valuation and the external dependencies.
Okay.
The stock trades at a significant premium to its own history, to its direct competitors. This suggests much of the good news, much of the optimism, might already be reflected in the current share price.
Price for perfection.
Potentially. And that lofty valuation makes the stock vulnerable. Vulnerable to a big correction if we see a sustained downturn in commodity prices. Furthermore, the company's success remains entirely dependent on factors outside its direct control, namely the volatile prices of gold and silver themselves, the ongoing operational performance of its 33 mining partners, and those unpredictable political risks in the countries where those mines operate. That's the bear argument.
So it really does all come back to that core tension, the quality of the business versus the price of admission. Let's hit the valuation summary one more time. What's the bottom line for our listener considering the current price?
Right. The bottom line on valuation, the current share price, around $100.69, stands significantly above most intrinsic fair value estimates derived from standard discounted cash flow models. Those estimates seem to cluster somewhere between, say, $67 and $89 per share.
A big gap.
A noticeable gap. So for you, the potential investor, this clearly means that buying WPM at today's price is fundamentally a bet. It's a bet that the company's robust growth pipeline will deliver and that the bull market in precious metals will continue, allowing the company to essentially grow into its premium valuation over time.
You're buying quality but paying a premium for it.
Exactly. It's a quality stock, no doubt, but you are definitely paying a quality price for that quality and expected growth.
Okay, last question then. What's your concluding outlook on Wheaton Precious Metals for our listener? What kind of scenarios should they be considering as they weigh up whether WPM fits into their own portfolio?
Well, look, Wheaton Precious Metals is undeniably a best-in-class company in its niche. It offers a really unique and strategically quite advantageous way to invest in the precious metal sector. The decision for any potential investor really hinges on their personal view of two key factors: where they think commodity prices are heading and their willingness, their comfort level paying that premium price for quality and growth.
So maybe think about different futures.
Yeah, we can maybe outline three broad scenarios for listeners to consider. First, a base case. Let's say precious metals prices remain stable, or maybe just rise modestly from here. And let's assume the company broadly meets its production growth targets. In that scenario, you should probably expect solid, but perhaps not spectacular, returns from Wheaton, driven mainly by its generous dividend and steady earnings growth, likely tracking the broader market, more or less.
Okay, solid, but maybe not shooting the lights out.
Right. Now consider a bull case. Imagine those geopolitical and macroeconomic tailwinds really pick up steam, pushing gold and silver prices significantly higher than they are today. In that scenario, Wheaton's inherent leverage to prices would likely cause its earnings and cash flow to expand dramatically.
Big upside.
Potentially huge upside.
Isn't
This
it?
would probably lead to substantial share price appreciation, likely accelerated dividend growth, and almost certainly significant market outperformance. That's the dream scenario for holders.
And the flip side, the bear case.
Conversely, the bear case. What if, say, we get a strong global economic recovery that significantly reduces the safe haven demand for precious metals? That could lead to a sharp price decline in gold and silver. If that happens, Wheaton's revenue would fall, and its high valuation multiple would very likely contract, maybe sharply.
Double whammy.
Could be. That combination could lead to a significant decline in the share price, even if the company's underlying operations and streams remain perfectly sound. So, ultimately, Wheaton Precious Metals represents a high-quality, low-to-risk way to get growth exposure within the precious metals space, but it definitely comes at a premium price today.
So if the traditional way of mining for gold is all about digging deep into the earth, maybe the truly deep dive into precious metals now is actually about digging deep into these complex financial models and partnerships. Something to think about. That's all the time we have for this deep dive. Remember, please do like and subscribe to the 1 Ounce YouTube channel for more coverage of mining companies. And hey, let us know what stocks you want us to cover in the precious metal space. We do take requests.
And just the necessary disclaimer. This analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
And as always, the insights and research shared here today were also powered by AI. We really hope it helped you become truly well-informed on Wheaton Precious Metals.